Today, we're going to go through some foundational knowledge through an introduction to financial investments. What you'll take away from this is an understanding for why to invest and what the benefits are, the three main types of investment vehicles, and the advantages and disadvantages of each. So, why invest? What are the benefits? Well, we know that every year the cost of living and the prices of goods increase. This is called inflation. So, for example, a cup of coffee might be $2 this year, $2.25 next year, and $2.50 the year after that. The prices continue to increase every year. So, this means that if you have $100 saved in your bank account, you are losing purchasing power every year. Because as the prices increase, you won't be able to buy as many items with the same amount of money that you had. So if you have $100 in your bank account and coffees are $2 each, you can afford 50 coffees. But when the price increases to $2.50, all of a sudden you can only afford 40 cups of coffee with that $100. So this is where investing comes in. Investing enables you to grow your money over time, keep up with inflation and preserve purchasing power, and achieve long-term financial goals. So let's talk about risk versus return. With investing, we must understand risk and return. There's always different risk factors with different types of investments. So some investment types are high risk, which means potentially you could have high returns, but there are also high potential losses. You could potentially make a lot of money, but you could potentially lose a lot of money as well. Other investment types may be low risk, and that generally means that the potential returns are lower, but so are the potential losses. You won't lose a lot of money, but you won't make loads of money. And so when investing, it's important to understand your risk tolerance. How much risk are you comfortable with taking? And also think about your time horizon. What's your plan with the investment over time? Are you looking to use the money in a couple of months? If that's the case, then you should probably avoid something risky. But if you are able to let the investment sit for years, then there's more time to experience the ups and downs of the market. And so the longer your time horizon, the more risk you can generally endure. So what is diversification? Diversification is an investment strategy that involves spreading your investments across a variety of assets or securities within a portfolio. So instead of putting all your eggs in one basket or putting all your money in one investment, you spread out the eggs into different baskets and you spread out your money into different types of investments. So by diversifying, you aim to reduce the overall risk of your portfolio by allocating your investments across different investment types, industries, or geographic regions. And different investments often perform differently under various market or economic conditions. So by having that mix of investments, if one investment performs poorly, the potential losses may be offset by the potential positive performance of other investments. So let's talk about the three main types of investment vehicles. There are debt instruments, also known as fixed income, equity instruments, also known as stocks or shares, and also investment funds. So we're going to talk about debt instruments first. Debt instruments indicate that money is being borrowed and one party is in debt to another. So the cost of borrowing that money is called interest, and the borrower pays interest until the initial principal amount is repaid. So the investor collects that interest money until their money is repaid back to them. And an example of a debt instrument is called a bond or an investment bond. So here's how it works. There's you, the investor, and then another party wants to borrow money. So you give them the principal amount. And then until they pay back that principal amount, they owe you extra money in interest. An example of a debt instrument is a bond. So in this example, you invest $1,000 in a 10-year bond with 5% interest. So 5% of $1,000 is $50. So every year you get $50 in interest. So you get this interest payment every year for the 10-year period. And then at the end of the 10-year period, the borrower pays back that principal amount, the original $1,000. But you've also gained the interest. So now let's talk about equity instruments. Equity instruments are all about ownership. It's not borrowing, it's ownership. Equity instruments are also known as stocks or shares because the investor purchases a share of the company and gains some ownership. The value of the share of the company fluctuates with the company's performance. So if the company performs well and is profitable, the investor's share in the company will increase in value. But if the company performs poorly, the share will decrease in value. So here's how it works. In this case, you provide your money or capital to the company as your investment. And in return, they provide you with some stock ownership. Now, let's say for an example, you bought a stock for $100. After a year, the company performs so well that the value of that stock doubles to $200. So you, as the investor, then decide to sell the stock and cash it out for $200, making a profit. Now, the final one is an investment fund. And an investment fund is a collection or mixture of investment vehicles. So when you buy a share of a fund, you are buying small portions of many different investments. So some examples of investment funds include mutual funds and what are called ETFs, or exchange traded funds. So when it comes to investment funds, you as the investor will invest your money or capital into the investment fund, and you get a fund share. So one share of that collection or pool of multiple stocks and interest opportunities. So let's say, for example, you spend $50 on a share, and inside of the fund, some stocks have increased, some have decreased, but overall, the overall value of the fund has increased. So now when you go to sell your fund shares, you cash out at a profit. So now that you understand the differences between the investment types, let's talk about the advantages and disadvantages of each one. Starting with debt instruments. Now, debt instruments, bonds, for example, have fixed income. So you know exactly what you're going to get. There is a guaranteed return and no risk. But on the other hand, the returns are limited to the investment and interest amount. So the more you invest, the more interest you would get, but it's limited to that amount. But overall, the returns of this investment type are generally regarded as low. For equity instruments or stocks or shares, they have unlimited potential returns. It all depends on how well the companies that you invest in perform. But on the other hand, that being said, this also means unlimited potential losses. So this investment can be considered high risk. And finally, funds provide you with the ability to access many investments at a low cost of entry. So you don't have to invest in each and every single individual stock or opportunity. You can just invest in the fund and have your hand in multiple investment types. So this also saves you time because you don't have to trade individual stocks. Now, these investments are considered lower risk because the losses are balanced out by any gains in the fund. This is the principle of diversification. And another benefit is that the funds have a fund manager, so someone is watching and keeping an eye on all the investments. But the disadvantages include paying management fees for that fund manager, and also lower returns if the gains in the fund are offset by the losses. So the point is, the more you know, the better decisions you can make when you craft your unique investing plan. Good luck.